For 2 decades, thousands of investors, big institutions and ordinary retirees alike, handed their money to one man. Banks did it, retirees did it, even the people whose job was to catch fraud did it. Here's the strange part. Regulators had his paperwork on their desks 5 separate times. They read it. They closed the file, and they moved on. Today we go through exactly how one man fooled almost everyone for 2 decades and exactly where the warning signs were the whole time. This isn't a story about a genius con man outsmarting the world. It's a story about a machine, a simple one, that kept running because nobody stopped to check it. By the end, you'll know exactly how the machine worked, why it took 20 years to break, and what actually happened to the money. Bernie Madoff started his firm in 1960, according to widely reported historical accounts. At first, it was completely legitimate, a real stock trading business on Wall Street, but over time, Madoff built a second business inside it, a private investment arm. Clients only, he told them he used a strategy called split-strike conversion. That sounds complicated. It isn't. Here's the plain version: buy a batch of big-name stocks, then buy insurance-like contracts that limit how much you can lose and how much you can gain. On paper, it sounds steady, modest, boring. Exactly the kind of boring that makes rich people trust you with everything they have. But here's what nobody expected. Madoff wasn't running that strategy at all. According to the SEC's own complaint, not one of those trades ever happened. Not once in years of statements. Think about that for a second. Clients opened envelopes every month. Real numbers, real trade dates, real-looking prices, all fake, built backward. Investigators later described it as fiction written using yesterday's newspaper. Take real historical stock prices and paste them into a fake trade that would have made money. So if he wasn't trading, where did the returns come from? Here's the part that makes this a Ponzi scheme, and not just a lie. When an existing client asked for their money back, Madoff didn't sell any stock to pay them. There was no stock to sell. According to court filings and financial reporting, he paid them with money that new clients had just deposited. That's the entire trick. Old investors get paid with new investors' cash. As long as more money keeps coming in than going out, nobody asks questions. And for 20 years, it kept coming in. But a Ponzi scheme has one obvious weak point. Eventually, you run out of new people to ask. Madoff solved that problem without ever having to ask anyone himself. Instead, large investment funds, known as feeder funds, collected money from thousands of ordinary investors, then handed it to Madoff as one giant lump sum. One of them, Fairfield Century, alone funneled more than $7 billion to Madoff. Another, Tremont, put in over half of everything it managed, $3.3 billion. These funds charged their own clients a fee every single year for something specific, doing careful checks on where the money was really going. Except there was a problem. Court filings and lawsuits later alleged that due diligence, those careful checks, mostly wasn't happening. Most of these investors never saw a single Madoff statement directly. They trusted the fund trusted Madoff, and the deeper checks that were supposed to happen in between mostly didn't. Years later, some of those same feeder funds had to hand money back. King 8 returned $860 million. Ascot Partners returned $281 million, money that regulators and courts said should never have gone in blind in the first place. But that raises the obvious question. If the money trail ran this wide, why didn't regulators catch it? They almost did. One person tried to stop this for 8.5 years. His name was Harry Markopoulos, a financial analyst, not a whistleblower inside the company. An outsider who simply looked at Madoff's numbers and did the math. In the year 2000, he sent the SEC a written warning. Nothing happened. In 2001, he sent another. Still nothing. Here's the memorable one. In November of 2005, he sent a 21-page report with a title that left no room for doubt. The world's largest hedge fund is a fraud. It listed around 30 separate red flags, and this is where it gets almost unbelievable. One of his findings: across more than 14 years, Madoff reported losing money in only 4 months. 4. No real trading strategy on earth does that, not even the best ones. Another finding, on some days the volume of options trades Madoff claimed to be making was larger than the entire market for those options. All of it, everywhere, combined. A mathematical impossibility. You cannot trade more of something than exists. But here's what nobody expected. The regulator with the paperwork sitting right in front of it still didn't act. This part isn't a theory. It's the SEC's own conclusion about itself. In 2009, the SEC's Inspector General published a 457-page report investigating its own failure to catch Madoff. Its own words, staff failed to ask obvious questions, and supervisors actually discouraged looking further. And this had been going on far longer than Markopoulos's warnings. Go back to 1992. The SEC sued a small Florida firm for illegally selling investments, and the money behind that firm all led back to one manager, Bernie Madoff. The SEC accepted account statements as proof everything was fine. Madoff himself vouched for them. Except those statements were forged. The SEC closed the case anyway and never looked at Madoff directly. That was 16 years before his arrest. In total, the SEC's own count, at least 5 separate examinations or investigations touched Madoff between 1992 and 2008. 5 chances, 0 results, so who was checking his books on paper? A single accountant, working out of a small office, the only person at his own firm. The SEC later charged that he never performed a real audit at all, and never confirmed the securities even existed. One giant financial empire, one-person audit, 0 real trades, and still 20 years of trust. So how does something built on nothing finally fall down? It only takes one thing, everybody asking for their money back at once. In September 2008, Lehman Brothers collapsed, and markets around the world panicked. Frightened investors everywhere started pulling cash out of everything, including quietly out of Madoff. By late November, according to financial press reconstructions of the court record, requests to withdraw were piling up faster than new money was arriving. The machine needs new money flowing in. That month, it stopped. And this is where it falls apart completely. On December 10, 2008, Madoff sat down with his own 2 sons, who worked at the legitimate side of his firm. He told them the truth. His own words, according to the criminal complaint, the whole investment business was one big lie. A giant Ponzi scheme, his sons reported him. The next day, December 11, 2008, the FBI arrested him at his Manhattan apartment. 20 years, 5 SEC investigations. 1 phone call from his own children ended it in less than 24 hours. On March 12, 2009, Madoff pleaded guilty. 11 federal felony counts, including securities fraud and money laundering. 3 months later, June 29, 2009, a judge gave him the maximum, 150 years in prison. Days before that, the court ordered him to forfeit about $20.8 billion in assets, a figure representing everything that had ever flowed through the fraud, not money that still existed to take. Now, here's a number you've probably heard, $65 billion. The amount Madoff stole. But here's the part almost nobody explains, that $65 billion was the fictional total sitting across roughly 5,000 fake account statements. Paper gains, compounding for decades that were never real to begin with. The actual cash, what people really put in minus what they'd already withdrawn, comes to somewhere between $17.5 and $20 billion. Still an enormous number. Just not the same number. So 20 years later, how much of that real money came back? Here's where it gets specific, because 2 separate efforts have been recovering it, and they're often confused as one. A court-appointed trustee, working the bankruptcy case, has recovered close to $14.8 billion and distributed about $15.4 billion to Madoff's direct customers. Separately, the Department of Justice ran its own fund, built from money seized in the case, including over $2 billion from one investor's estate alone. In December 2024, that fund made its final payment. Total paid out over $4.3 billion to more than 40,900 victims in 127 countries. For the people in that fund specifically, that adds up to about 94% of what they lost recovered. Not everyone touched by Madoff, but for those claimants, nearly whole. So, what actually took Madoff down? Not a whistleblower alone. He shouted for 8 years and was ignored. Not the regulator. It had the file 5 separate times and missed it 5 separate times. What took him down was simpler and almost accidental. Markets fell. People asked for their money at the same time, and the machine, which only ever worked one direction, ran out of new money to move. The paperwork, in the end, had been sitting there the whole time. Nobody had to find a hidden clue. They just had to read what was already on the desk. That's the real lesson of the largest Ponzi scheme in history. It wasn't hidden. It was ignored. This channel exists to walk through exactly how these collapses happen. With sources you can check yourself, not speculation, if you want to understand the next one before the headlines catch up. Subscribe, and we'll see you in the next file.